In our second series on using cost analysis for decisions, we're going to be looking at a buy or make decision. We're going to be using problem 441. That's on page 138. I think that is. Yes, 138. So again, please have that available so you can look at it and see where we're getting uh, the information from. We have an owner of a business that is trying to make a decision whether he should continue to buy a product for 60 cents each or make it in-house. The initial cost analysis shows the following cost to produce the product. And at first blush, it looks like, well, it's kind of a no-brainer. It's going to cost you 80 cents when you can buy it at 60 cents. But we need to look and see whether these costs are relevant. First, we have the direct material. Currently, it's costing him nothing. If he makes them, it's going to cost 20 cents. Well, that changes between alternatives. Every unit of the product we make, we're going to incur a cost of 20 cents. So yes, that cost is relevant. The same with our direct labor. Next, the overhead is broken into two components, a variable overhead and a fixed overhead. The fixed overhead would not be avoided if we continue to buy the cookies from the outside. So the variable overhead is avoidable, does differ between alternatives, but even though we're not showing that fixed overhead in our buy column, that actually is still there since the company cannot avoid it, and it is not relevant to the decision whether we should buy or make. So, for our relevant decision, the things that we're going to use to compare is going to be the direct material, the direct labor, the variable overhead. The fixed overhead will not be relevant to this decision. So we're going to go ahead and total up our cost that would incur if we were to make the cookies as opposed to buy it. And we see that there is a difference of 10 cents if we chose to buy it. So we'll be incurring additional costs of 10 cents if we continue to buy the cookies as opposed to make it. And the critical piece right here is the fact that the fixed overhead cannot be avoided. And you can see that in the last sentence of the first paragraph. That reads, however, total fixed overhead for the company would not increase if Mel's makes the cookies. So that is our critical decision point. Since these costs cannot be avoided, they are not relevant to the decision and not included in our analysis.